Hi everybody, Steve Rising here with Thin Slice Trading at the Forex Trading Institute. I'd like to talk a little bit today in a quick video tutorial about Forex price dynamics and swing trading versus scalp trading. Oftentimes folks feel like swing trading is the way to go. They're under the idea that it's less maintenance. In other words, they can just place a trade, sit back, wait a couple days, and then cash in on the trade. Which is beneficial trading, for instance, in the equities market, trading a stock, or in the futures market, trading, for instance, a commodity. But attempting to swing trade in the Forex is very difficult, specifically because the directional bias of this marketplace is constantly shifting. In other words, the way a currency pair trades is not the same way a stock or a commodity would trade. One of the primary reasons is when we look at, for instance, a stock, it's to everybody's benefit for price to increase in value over time. So if price moves in one direction for a consistent period, everybody's happy. It's not to the benefit of a country for their currency to move in one direction for extended periods of time. And this is where central bank intervention steps in. So typically what happens is a currency pair is range bound greater than 80% of the time, and then less than 20% of the time we may get a little bit of a move where the directional bias is consistent, but that move typically only lasts for between 24 and 36 hours. In fact, statistically looking at 5 years of market data, the extent of the directional bias is typically 24 to 48 hours. So I'd like to talk a little bit about that, because to be a swing trader and to attempt to try to trade a move in one direction for a 2 or 3 day period, when in fact the move typically lasts less than that, it's important to understand that, and that's why more people are successful scalp trading the currency markets or a currency pair than they are swing trading. Because swing trade opportunities occur very infrequently, where we literally can scalp trade every single day. So we'll start off here looking at the daily chart. Here, this is the British pound versus the US dollar, because the daily chart gives us a very good overview of what's occurring every single day in the marketplace. Each one of these candlesticks represents 1 day of price action, so we can see the extent of the move in a 24-hour period. So we can start out here. Here we are currently, as of the making of this recording here. That's today's activity. Remember, each one of these candlesticks represents 1 day of activity. And the typical type of price action that we see with the Forex market is that we're range bound, and here we can see a trading range right here. And then what happens is the top or the bottom of that range is breached or cleared. And then we go into what we label here at the Forex Trading Institute with the thin slice methodology, momentum-based conditions, because it's not a trending condition, because a trending condition refers to a tendency of an entity in a marketplace over an extended period of time. And so this momentum-based condition does not last for an extended period of time. So it would be the misuse of the word trend. So what we have here is we can see our top of range was cleared here. Let me clear up my circle here. We can see that our top of range was cleared here. Actually, yesterday we had our momentum-based activity. Remember, each candlestick represents 24 hours. So less than half of the day we had a little bit of momentum-based activity. We actually got a little bit of the extension of the move from midnight today moving into Eurozone session. And then we can see now we've shifted right back into a range. So for instance, to attempt to try to swing trade any of this activity, if you were assuming that you had a bullish opportunity that was going to occur for a few days, one of the problems is that if in fact this move does decide to continue, it may not continue for a few days. And what that means is, in other words, if we get an extension of the move here at some point in time here, when we clear, in other words, we typically expect to go into a range here. If we get an extended move here where we then continue that bullish opportunity, you literally would have to be trading with a minimum of a 250 pip stop, ideally a 300 pip stop, to overcome this range, waiting for price to move back in, and it may take a number of days. The reality is, psychologically, most people don't have the stamina to sit in these sideways conditions as market pulls back against them, and they're in the negative for 2-3 days waiting for price to come back around. And so from a psychological and emotional standpoint as well, most people prefer to scalp trade the Forex market because they can get in, get out, achieve their profit objective, and essentially, as traders say, they're flat at the end of the day, so they sleep better. You don't have to hold positions. So we can see here, just going back, this was a range here. The range was a little bit tighter. And so we were in the top of range, a little easier to identify than the bottom of range. Our top of range cleared here for, once again, a very short period. We then immediately topped out, so there again, if you were attempting to swing trade, and the term swing trade means holding a position for over a 24-hour period, typically 2 to 3 days. So you're bullish, and now all of a sudden, same situation. The very next day, you're bearish for the entire day. So here again, waiting for the move to extend again, 250 pip stop to overcome this back and forth activity, and now you get a little more of an extension of the move right here, and now you're back here once again waiting for price to take off and move in your direction. So the reality is we can actually make more consistent profit, and we can actually make the same amount of profit scalp trading as we can swing trading simply by bundling lots. And you'll find one of the key distinctions of Forex price action is the moves are very short-lived. They're not as extended as oftentimes we're led to believe by sometimes marketing hype that's on the internet. Because once again, the directional bias is constantly shifting. In fact, we can see here, we'll go back here. Here's the start of the day right here. At this point right here. So we had one move that occurred right here, literally in less than an hour. These are 10-minute candlesticks, the perfect time frame to trade this market on an intraday basis. And then literally price went flat here for about 6 hours before then we had a second move. Now with our thin slice methodology, we would have been able to take advantage of both of these quick short moves from a scalping scenario. And then why have to sit and, as I call it, white knuckle it out as market goes flat for 6 hours, and in some cases more, waiting for the extension of the move to occur. We can then see that price bottomed out, which is very typical. We're now establishing a new bottom of range, and the directional bias is shifted, and we've reversed in the exact opposite direction, which is very common trading the currency pairs. We can be bearish in one session and bullish in the very next session. So at this point, if you were waiting for that move to continue to try to trade this southerly move, if you will, currently you would have to be working off of a 200 pip stop to overcome this pullback that's occurred, waiting for price to move back in this direction. And once again, we know that it may take 2 or 3 days for that to occur. And so that's why it's much more beneficial to scalp trade this market than try to swing trade this market, because the more predominant condition is range-bound activity. And that typically the extent of the moves last about 30 to 50 minutes, and then price goes flat for an extended period of time before we then get an extension of that move. So the scalp trader can get in, grab the move, get out. Market goes flat. If there's another opportunity to get in and trade the same direction, he can then jump back in and take a second setup. Doesn't have to be time intensive either. Our traders here at the Forex Trading Institute, when they become adept at trading the thin slice trading methodology, can literally set alarms to be notified by text message or email when price is moving back into the vicinity that they need it to be in to either trade the extension of the move or the reversal activity. So if you'd like to learn more about why scalping the Forex is much more profitable, it's easier, less risk, and less time intensive than swing trading, please attend one of our free online trading seminars. We actually are going to have one today at 1 p.m. Eastern Standard Time, and we'll be sending out a reminder email today as well with the link to access that. So once again, I'm Steve Rising with Thin Slice Trading at the Forex Trading Institute. Thank you for your time.